Okay. We'll do some introductions. Sam and I will introduce ourselves, and we'd love to hear from the three of you. We'll probably have people coming in and out. We usually have people sometimes that join late. We have left plenty of time for Q&A just because I think with the topic and like the state of the market, a lot of you are going to want to ask some questions. So we're going to probably leave an extra 5 to 8 minutes at the end. We usually only have 5 minutes, so we're going to add a little more to that. So today is a market update, and because we're getting almost to midway part of the year, because we're halfway through June, but we will get to the end of June soon. We really wanted to give you a market update, and it was very timely because particularly what's going on with mortgage rates and mortgage, Sam is going to have a lot to illuminate for all of us. I'm going to look more on the housing side of things. Yeah, a lot of the conversation to me is going to be inside of rates, mortgage, and then how that will affect buyers. So my name is Shannon Shue. I'm a real estate agent and an investor. I'm in the top 1% of Keller Williams agents across the country. I was very grateful, actually. I won a Real Trends Award. I'm in the top 1.5% of agents nationwide. Doesn't matter what brokerage you're with. So thanks, guys. I love the support. I appreciate it. So I have 16 units and I own a self-storage facility. I love Vietnamese spring rolls, and I really have a vision for the world to create connection through vulnerability. And that's a little bit about me. Sam.
Well, thanks, Shannon. I'm Samantha Shur. I'm a VP of Mortgage Lending at Origin Point and a founding member of Origin Point. I just started here in May and been almost 20 years in the mortgage industry altogether. I own a single family home with my 2 daughters and my husband, and absolutely love Belgian waffles. It was actually part of a little game we played last night. I drew a Belgian waffle. It's like a game of telephone with drawing, and my daughter thought it was an iPhone. I was like, of course you thought it was an iPhone. It's a Belgian waffle. But anyway, yes, yesterday's news was probably shocking to a lot of people. One of my clients said that he texted me, today's Fed rate hike was terrifying. And I was like, wow. So probably a lot of people feel that way. I was not terrified. I was actually quite happy because the Fed did what they said they were going to do. And I think it's going to be really great for us for inflation, to fight inflation. So we can get right into it. But before we do, Shannon, you want to go to the next slide?
Yep.
We'll talk about our agenda. So we're going to talk about the Fed rate hike. We'll talk a little bit about how that's affecting real estate here, and then how to buy in today's market. I know all of you have purchased properties before. You've been in real estate for some time. So we'll see who joins if we want to really focus on that or speak more about the market. So Shannon, you want to go to the next slide? So first, we'll just introduce each other. I know a lot of you don't know each other, so
Pardon me. All right. Sam, shall I go through this? Or?
Yeah, I mean, everybody on the call today understands why to buy a house, but go for it.
Yeah, so I think that this is a slide we often use to sort of get us into the meat of our presentation, and really, why do people buy homes? And regardless of where we are in the market, it is of course part of our retirement plan. It's part of my retirement plan. It helps create passive income in both the short term and certainly the long term. When we are retired, we want to have a little bit more because we're not going to be working. There's the appreciation, because Los Angeles is a completely appreciation city. We don't have a lot of cash flow initially. We usually buy with the intention for it to appreciate. And then tax benefits that we have when we own property, where there's depreciation, and then also the expenses. And then of course a stable housing payment, because it's fixed for 30 years. Even if you're in an ARM, hopefully it's fixed for at least 10 years, the longer one versus the shorter ones. Either way, it's a fixed amount. And then the intention is that you can always refi along the way when rates get very attractive, which today they are not as attractive.
But they will be when the recession's over. Yeah.
Yes, exactly. And the recession is not going to last 10 years. We know that. We don't even think it's going to last 5. I think most of us know that too. I'm going to kind of go through a little bit of like what I'm seeing in the housing market. So in the housing market, this is nationwide. So of course, a high $300,000 home is nearly impossible to find in Los Angeles. However, when we look at the national average, home prices right now, as of 2022, even though June we see a slowing, we don't have all of June numbers yet. We are still above. We're at 378 as a national average, but if you follow the yellow curve, which is a 4% increase over time, we see that we are well above that, right? So we are so far above that we can price correct down and still be in a lot of, quote, positive appreciation territory, which means you have your home is still appreciated. It's just not wild appreciation. Instead, we're at normal appreciation. So it's still worth more than you bought it for. If we take 2021 as an example, 347 was the average home price nationwide. And we're above the yellow curve line, and then 378 so far in 2022. What I imagine is going to start to happen, and I think this is what the feds want to do, is they want to bring the pricing down, slow the spending, and bring the amount of appreciation in line with where we are on the curve. So we're not overinflating home prices, right? Because a lot of buyers will say, well, it's just so unaffordable. This is crazy. The only other time that we have had this, at least in the last, since 1990, since this graph has been built, is during the run up to the 2007-2008 economic crisis, and especially it was in housing. So you can see that it went well above the curve. And so some people, a lot of buyers will say this now, and you're going to hear this conversation a lot. Well, then I'm going to wait for the crash, because then look at what it did after, right? We had to correct after that run up, and we have now sort of a deficit of where it was supposed to be. The only thing I say to people over and over again is I do not expect a crash. And the reason is we gave great loans over the last few years. The run up has been because we kept the interest rate so low, so borrowing money is so cheap, and it's cheaper than almost sometimes less than 3%. It's cheaper than regular inflation. When you have a normal, we are at over 8% inflation. So I don't believe we are going to have this crash that everyone thinks is going to happen.
And I think, Shannon, too, is a lot of buyers, first-time home buyers, especially right now, think that all recessions have to do with the housing market. And so They think that the crash was because, obviously we all know why we went into a recession in 2000, 2008, 2010, was because, lenders weren't evaluating loans like they are now. We just weren't regulated like we are. And so back then, because of that, so many people lost so much equity in their homes. And so everybody equates that to, recession means home prices are going to drop. And it's not. And we'll show in a little bit how how recessions actually, you'll see home prices continue to appreciate. So it's just that one time, but because it was most recent, everybody thinks that. We lost our slide, Shannon.
Yeah, I know. Sorry. Nope.
Too many screens.
I know. I did the slide. Sorry.
You want me to do it?
Yeah, could you?
Okay, you stop sharing.
Okay, stop sharing. Pardon me.
Sorry, guys. This will stop.
I have too many windows open. I have two monitors. I can't find the window. And I feel it's kind of embarrassing. Which window is it?
Oh, wait, this is not the right one either. Gosh, darn it. Okay, one more second. Share. We were on, hold on one second. Let's go back here and share.
I want to find it now. Oh, where did I put it?
Why did it do the same thing you did?
Put slideshow instead of share.
Yes. Oh, yeah. That's why. Okay, so anyway, moving to the next slide. Go ahead, Shannon, about the last recessions.
Yeah, so these are the last recessions we've had since the 70s. And if you, I mean, Robert, you remember, you said when you had the double-digit interest rates, that was probably in the early 80s.
That's right. Exactly.
Yeah.
You hit it. Yeah.
So in
82.
that, yeah. So it was the double dip, the 80s double dip 1 and double dip 2, right? And you look at the length of the recession time. At that time, you had a 6-month recession around February 1980. Then you had a 16-month recession around 1981. So those are examples where that you hear this a lot. The yield curve inversion started, which means that's where the GDP drops below 1.5%. And we've already had 1 quarter of that. And now the expectation is that when we close out June, the GDP will have 2 quarters of inversion, yield curve inversion, therefore constituting a recession. So we have to close out June though to see those numbers. But almost everyone says that the needle's already pointing in that direction. It'd be shocking if it didn't happen. And then you can see some of our other big recessions, right? And the longest recession was the global financial crisis of 2008. We just don't have the makings of that happening again. The pandemic did create a very short recession of 2 months, and the yield curve inversion actually happened before we shut down here in the United States, which was around early 2020 for most people. But as you know, the rest of the world was shutting down in 2019, end of 2019. So I share this with you because a lot of times we think recession, we don't know how long it will last. Sometimes we don't know the factors that really contributed to those recessions. But I think that as we look at what the pandemic has done, and then we look at how rates haven't, I don't think that we have more control over this particular recession than we did in the global financial crisis because of how we were just lending and parlaying the lending into lending on lending. And so then it was all built on sometimes valuations that were not substantiated. The dot-com bust, right? This like run up of like these stocks are going to do amazing. And then they don't, right? So people right now are pulling back, and that's why people are pulling their money out of the stock market even now, because they just don't want to be subject to any more of the market whims. So I hope that kind of, it's meant to build sort of a general recession picture when we have gone through recessions. Sam, do you have anything to say about what you think about the coming recession?
From what I've, been researching and whatnot over the last couple of years, because I know we were heading into a recession just before the pandemic, and we were knowing it was coming, right? Because every cycle has to come and go. The fact that we had that mini recession in 2020, maybe this will be a shortened one as well, is what I'm hearing. And I think over the years, the Fed, I've been told, like, Fed wears goggles, right? They don't really say that we're, because of political pressures and things like that all the time, they may not act the way the economy really needs it needs them to act. And I think yesterday's rate hike was actually them taking off those goggles and being pretty real. I mean, not everything they said in their statement was 100% accurate, because they think GDP is flat this quarter, and the numbers don't actually show that. But I think they also do it because they don't want to send everybody into a panic, right? So anyway, that being said, I think they took the correct measures. And I think over the years and over all of these other recessions in history, they've learned what they can do. And so let's go to the next slide. So Shannon, you put this one in. I don't know if you want to talk about this, and then I'll talk about the next ones.
Yeah, absolutely. So the Feds are fighting inflation by slowing spending. In order to slow spending, they need to increase the rate at which it costs money to borrow. So banks borrow and lend to each other, and then we lend on things, whether it's a credit card, for a car note, for a home loan, and then many other factors that go into inflation. But we are over leveraged in this country. We are way over leveraged, which creates inflation. We've given out way too much money at really low rates, and if everything had to get called on all of the loans we've given out across the board, whether it's like loans to other countries and then or our own car loan, we would be in big trouble. We don't have enough to support how much money we've given out, which includes for home loans. So that is creating inflation, and we are at 8.5% plus. The feds are wanting to slow that down by increasing the costs of money so that you spend less. If you hold your money, you save rather than spend, we can combat inflation. It does take time. It's not overnight. So it's going to combat inflation and bring their dollar back in line so that it doesn't cost $6.20 for a gallon of gas because that's inflated. We need to bring it back down to, well, we all hope it can get down to like under 5, maybe even
that would be, yeah.
I don't think under 4 is even possible, but like under 5 seems kind of in line with where we would like to be, because our incomes have not all caught up to that, right? We're not making more money, but now we spend more for everything we buy, right? And the only folks that are the most insulated against inflation are, of course, the very, very wealthy. They don't have to worry, okay, it costs more for gas, but they already have a lot of money. Either way, on this graph, you see that inflation, annual inflation, including food and fuel on the orange line is above 8.5%. But annual inflation excluding fuel, so things like a car note, things like a home loan are still high, but they're around 6. But they're not as high. So who is going to get hit hardest when it's consumer spending for the everyday necessities like food, fuel, housing, clothing, all these type of things? It is usually the working class and then middle class people are the most affected. So that's but when you buy more expensive things, excluding food and fuel, it's less in that category.
Okay, so what actually happened yesterday, just to kind of give you guys the cliff notes. The Fed raised rates by 0.75% yesterday. And contrary to what many of you think, and a lot of JEDS buyers are probably thinking is, mortgage rates went down. Okay, and why is that? Why did they go down about 3 yesterday? Well, that was because mortgage rates are already anticipating the increase from the Fed. They're talking about it, inflation's high, and so mortgage rates go up. And what the Fed controls is not actually mortgage rates directly. The Fed is controlling home equity lines of credit, right? So if you have an equity line of credit right now and it was sitting about 4% yesterday, yesterday afternoon it went to 4.75. If you have credit card debt and you have $10,000 of credit card debt that was sitting at whatever rate it was, maybe 10%, it's now 10.75. So that's going to, like Shannon said, put a, restrain a lot of people from spending more. And so then that will then trickle down, right? So the Fed says, okay, we're raising rates. So those of you who are putting a lot of money on your credit cards, you're gonna have a really hard time making these payments. Hopefully many people in middle class and beyond are able to, they start to cut back spending, right? So instead of buying all that stuff on Amazon or Walmart or whatever, they're going to stop. And then maybe Walmart's going to have to lay off a bunch of people because they're not having as much spending, right? And there's a lot of big companies right now discussing some future layoffs and things like that. And that's when all the correction takes place. So what a lot of people maybe didn't see in the announcements from the Fed is that they expect another 1/2 to 3/4 increase in July. They actually said 3/4 in July, 1/2 in September, 1/4 in November, and 1/4 if they have to in December. And this is all going to be based on what's happening in Ukraine, right? But as they increase and companies start to feel like, oh gosh, we're not selling as much, or maybe the airline industry is saying, well, people aren't vacationing as much, which they are, but so it's a very interesting time because of COVID. But what will happen is as unemployment spikes, right, that's when that recession really takes place and things start to really fall out and we'll start to see a recovery. So like I said, the Fed sometimes wears goggles. They said yesterday employment's going to stay around 3.4%, but it's very unlikely. It's going to go up, and it'll go up pretty quickly, and then it'll come back down again. It's just the cycle. So in a very clear, like, you know, back to kindergarten, rudimentary formula, recession takes like 4 different, if you think of like baking a cake, right? There's going to be 4 different things. 1 is inflation. 2 is the increase of interest rates. 3 is a spike in unemployment, which we just talked about. And 2 is 2 consecutive quarters of negative GDP growth. So when you have all of those together, we're in a recession. And just as Shannon said, probably on July 1st, there'll be a lot of newscasters who say we're now in a recession, because there likely will be 2 quarters then consecutive. And then this morning, so yesterday was interesting. Right after the Fed's announcements, we had repricing of interest rates for the better. They improved between 1/4 and 0.375 on most loan products. And then because we all anticipated this, right? Maybe mortgage rates have gone up too much, and the Fed's news was good. And so was good because we all expected it to happen. And so rates actually went down and corrected. But what happened is when the Fed, from the US Fed, shared the news with the rest of the world that we raised rates here, other countries started to do the same. The first time in 25 years, the Swiss bank raised their rate by 1/4%. Taiwan bank went up. Brazil bank went up by 9%, up to 9%. And so this sort of is creating this panic around the world right now. And so now stock market's down again. Mortgage rates went up a little bit. So the recovery we had yesterday kind of is flat again. But you know, this inflation that we're facing is not here just in the US. This is a recession that will be felt, you know, around the world. If you can see here though, I think some good news to share with potential homeowners or just yourselves, right? If you look at mortgage rates, this is this white line, right? And all the different recessions that Shannon just went through. The recessions are in the dark blue bars, dark blue columns. You'll see in the yellow sections that interest rates actually fall during a recession, because the Fed's going to want to, because they've now pushed the rates up so high, once they start to see the activity slowing down, they're going to lower rates to spark more economic activity again. So you'll see like in 2008, right, mortgage rates went up, down, and then all the way down to spur growth. So people started buying again, buying homes at, you know, early 2010. And then again in 2020, we had a huge drop in interest rates, but that was that mini recession that we had during the pandemic. I don't think a lot of people know this, that rates go down after a recession. So for people who are buying right now, or if you've just recently refinanced, or you're thinking of refinancing to pull cash out of a property to maybe buy another property, and you're thinking, oh my gosh, rates now are in the high 5s, low 6% for cash out refinance. More than likely, you'll be able to refinance these loans in, you know, a year, year and a half, or whenever this recession is over, and we'll have a mini refinance boom again. Another thing to see, I really love these slides because it really shares with you, and you can maybe, you know, easily digest it when you see it like this. So the housing price, as you can see, each recession is this dark blue column. And you'll see home prices have gone up. After every recession, beginning the recession to the end of each recession, home prices are up, home prices are up, home prices up. The only time, like we discussed, that they went down was in the 2008 to 2010 timeframe. And that was because the housing market created the recession, right? And so that's when it went down, but it's gone up, and we expect it to continue to go up. And for those who bought in 2020 during that recession, have seen huge growth, right? Shannon said 4% on average, but in 2020, 2021, in LA, we were seeing 20% increase in home prices, which is just absolutely out of control, which is why we're in this place again. So anyways, if for those of you who haven't purchased before or watching this call later on, what you first should do if you're looking to buy a house is to speak to a lender like me, get your pre-approval letter, and then meet with a realtor like Shannon to start writing offers. And just to share with you, at my new company, Origin Point, we're able to underwrite loans before the offers are made, right? Before a buyer actually decides to make an offer with a seller. And Shannon, I don't know if you want to weigh in here and talk a little bit about what's going on with buyers and sellers right now.
Yeah, sure. So just getting buyers to come back to the market if they've been looking and now they're discouraged because of June, everything in June that's happened, whether it's my stock portfolio is down, my crypto isn't worth what it was worth 2 months ago, and 2 months ago was already down from what it was worth in Christmas. And when I hear buyers say, I'm a little concerned about the increased interest rate and how it's going to affect my buying power. There's so many things economically that I think many buyers are trying to weigh in on or understand that making a large home purchase feels scary. So how I like to help is I say, okay, well, let's look at a property today. Look at the I use 6% as an interest rate now. I'm like, I bet Sam could get something lower than that, but might as well, let's go with the most 0 point down.
6% is an average interest rate. If you look at all of those years, I could show you another graph that shows the average rate is 6%.
Yeah, so let's use 6%. Let's say you're gonna buy this property today at this, at whatever price it is, and then look at that interest and look at that monthly payment. And then I ripped $50,000 off the price, but increased the interest by an additional half point or point, right? And then you can see as the price goes down, the interest rate goes up, and like, well, are you somewhat even today or doing better every time I step it up? So I share screen with them and we literally look, take 50K off, 100K off, 200K off, but now you have to increase the price, increase the rate, lower the price. And for the most part, you're staying even-ish until you don't. And that is where you get to about 7.5 or 8%. You have to take 16 to 20% off of the price. And I said, I do not believe that this market in Los Angeles will see a 20% discount in a home. I do believe you could get to 10. 5 to 10 does not seem out of the realm of reason. But do we actually believe that this home will sell for $400,000 less? If it's a $2 million home, it's going to sell for 1.6. Do we actually believe it's going to have a 20% discount? That's really hard for me to stomach, like as an agent and looking at the market. Because if I were the seller, I would say this, forget it. I'll rent it. I'm going to wait this out 2 years. We'll put it back on the market, right? Unless you have to sell, and then you will take that 1 point. I don't think it's going to be 1.6 still. We don't have enough inventory. So that's where I think we are when it comes to the inventory we have. That's not going to be able to support a 20% discount. We just don't have enough inventory, but we can support some level of a quote discount because the run up has been unbelievable for the last 2 years. So give a little bit back. You're going to give it back in the price, but you're going to pay for it in the mortgage. It's a trade-off.
Yeah, that's a really good comparison, Shannon. And I think it makes it really clear to your buyers. I think that now, Jed, you might be seeing too, when you're putting offers for buyers, that sellers might be a little more willing to take that first or second offer. There's not as many people lined up to buy that house. You're not seeing, Shannon, probably 23 buyers on the same property, although some are, right? It just depends on, the price range. I think in that like $1 million to $1.5 million right now for first-time home buyers is a coveted price range. And you're still seeing, a few $100,000 over and things like that. It just also depends on where the seller has listed the house.
Yeah.
So, yeah. Well, I think, so it's 12:40. Maybe we could just go around and we can see what people have learned today. If you want to go ahead and share, and we can open it up and talk more about this very interesting topic. So Robert, do you want to share first?
Yeah, I have a